Are you about to get hundreds more pounds every single year, or are you missing out on money that's rightfully yours? If you're receiving or approaching state pension age, what's about to happen in April 2026 could change everything about your retirement income. Some pensioners will see a massive boost, while others might face unexpected surprises. Stay with me for the next few minutes because I'm going to break down exactly what's changing, who's getting what, and most importantly, what you need to do right now to make sure you're not left behind. Welcome back to Pension Path UK, the channel where we cut through the confusion and bring you clear, straightforward information about your pension and benefits. I'm here to help you navigate the complex world of UK pensions so you can get every penny you're entitled to. If you're new here, make sure to subscribe and hit that notification bell because we're constantly updating you on the latest changes that affect your money. Today, we're diving deep into the confirmed 22 to 26 DWP pension changes. This isn't speculation anymore. The Department for Work and Pensions has officially announced the exact figures, and I'm going to walk you through everything you need to know, from the new payment rates to eligibility criteria, payment dates, and even some hidden details that most people miss. We're covering it all. Let's start with the headline news. The state pension is going up in April 2026, and it's a significant increase. Thanks to the triple lock system, pensioners are looking at a 4.8% rise. Now, you might be thinking, what does that actually mean in real money? Well, let me break it down for you. If you're receiving the new state pension, that's the pension for anyone who reached state pension age on or after the 6th of April 2016. Your weekly payment is jumping from £230 and 25 pence to £241 and 30 pence. That's an extra £11 and 5 pence every single week. Multiply that over a full year, and you're looking at an additional £570 landing in your account. That's not pocket change. That's real money that can help with rising energy bills, food costs, or simply give you a bit more breathing room. Now, if you're on the basic state pension, which applies to those who reached pension age before April 2016, you're also seeing an increase. Your weekly amount is rising from £176 and 45 pence to £184 and 90 pence. That works out to an extra £8 and 45 pence per week, or roughly £439 extra per year. But here's something crucial that many people don't realize. These are the maximum amounts. Not everyone receives the full state pension. Your actual payment depends on your national insurance contribution record. To get the full new state pension, you need 35 qualifying years of national insurance contributions. For the basic state pension, you need 30 qualifying years. If you have gaps in your record, you might be receiving less than the full amount, and that means your increase might be proportionally smaller. This is where it gets really important. If you're not getting the full amount and you have gaps in your national insurance record, you may be able to fill those gaps by making voluntary contributions. This could boost not just your 2026 payment, but your pension for the rest of your life. It's definitely worth checking your national insurance record on the government website to see where you stand. Let's talk about the triple lock because understanding this is key to understanding why pensions are going up by 4.8% this year. The triple lock is a guarantee that was introduced back in 2010. It ensures that the state pension increases each year by whichever is highest out of three measures. The rate of inflation as measured by the Consumer Prices Index in September of the previous year, which was 3.8% this time. The average increase in wages across the UK between May and July, which was 4.8%, or a minimum of 2.5%. For 2026, earnings growth came out on top at 4.8%, which is why that's the figure being used for the state pension increase. This triple lock system is designed to protect pensioners from falling behind either the cost of living or the incomes of working people. It's been a political hot topic over the years, with some arguing it's unsustainable in the long term, while others say it's essential for protecting older people from poverty. Now, here's an important detail about additional state pension. Some pensioners receive what's known as additional state pension on top of their basic pension. This used to be called SERPs, or state second pension. If you receive this additional element, it's increased differently. While the main state pension goes up by 4.8%, the additional pension element is increased in line with inflation, which means it goes up by 3.8%. It's a smaller increase, but it's still an increase nonetheless. Let's move on to when you'll actually see this money. The increases come into effect from the 6th of April 2026. That's the start of the new tax year. If you're already receiving your state pension, you don't need to do anything. The increase will be applied automatically to your payments. You'll simply see the higher amount show up in your bank account when your next payment arrives after that date. Your payment schedule depends on the last two digits of your national insurance number. Most pensioners are paid every 4 weeks, and the payment day remains the same. However, it's worth noting that if your payment date falls on a bank holiday or weekend, you'll be paid on the working day before. This is standard practice, but it's always good to keep an eye on your account around bank holidays to make sure everything goes through as expected. Now, before we move on, let's talk about something that affects many pensioners, but doesn't always get the attention it deserves: pension credit. This is a benefit designed to top up your income if you're over state pension age and on a low income. The really important thing about pension credit is that it's massively underclaimed. Thousands of pensioners who are entitled to it simply aren't claiming it, which means they're missing out on money that could make a real difference. Pension credit rates are also going up in April 2026. The standard minimum guarantee for single people is increasing, as is the rate for couples. If you're not sure whether you're eligible for pension credit, I'd strongly encourage you to check. Even if you think your income might be slightly too high, it's worth investigating because you might be surprised. Claiming pension credit can also unlock other benefits like help with housing costs, council tax reduction, and free TV licenses for those over 75. Another thing to be aware of is how these pension increases might affect your tax situation. The state pension is taxable income, but it's paid to you without any tax being deducted. Your personal allowance for the 2026-2027 tax year is £12,570. If your total income from all sources, including your state pension, other pensions, employment, savings interest, or rental income, exceeds this threshold, you'll need to pay tax on the amount above it. With the state pension increasing, some pensioners who were previously just under the tax threshold might now find themselves tipping over into taxable territory. If you receive other pensions or income on top of your state pension, your tax code might be adjusted so that tax is collected through those other sources. It's worth keeping an eye on this and checking your tax code to make sure you're paying the right amount. Here's something else that's happening in 2026 that you should know about. The DWP is also updating several other benefits that affect pensioners and working age people. Universal Credit Standard allowances are getting a 6.1% increase, which is higher than the general benefit increase of 3.8%. Attendance allowance, which helps people over state pension age who need help with personal care, is also going up. The higher rate is increasing to £114 and 60 pence per week, while the lower rate goes to £76 and 70 pence. There have also been discussions about pension transfer times. Thousands of people have been calling for faster pension transfers, with campaigns pushing for a 10-day pension switch guarantee. The DWP has acknowledged these concerns and has indicated they'll be launching a formal consultation about modernizing the pension transfer system. If you're planning to move your pension between providers, it's worth keeping an eye on these developments because the process might become much quicker and easier in the coming years. For those of you approaching state pension age, it's worth thinking strategically about when you claim. You can actually defer your state pension if you want to, and if you do, your pension increases for every week you defer it. The longer you wait, the bigger your eventual payments will be. For some people, especially those who are still working and earning a good income, deferring can make sense both from a tax perspective and from a long-term income perspective. However, it's not the right choice for everyone, so it's worth getting personalized advice if you're considering this option. Let's also address something that causes confusion. What if you live abroad? The pension increase rules are different depending on where you live. If you live in a country that has a social security agreement with the UK, you should receive the annual increases just like pensioners living in Britain. However, if you live in what's known as a frozen rate country, one without such an agreement, your pension gets frozen at the rate it was when you first claimed it or when you moved abroad. This affects pensioners in countries like Australia, Canada, and South Africa, and it's been a source of controversy for years. Looking at the bigger picture, these 2026 increases reflect ongoing debates about pension sustainability and fairness. On one hand, the triple lock has successfully protected pensioners from poverty and ensured their incomes have kept pace with the rest of society. Since its introduction, pensioners have generally seen their incomes grow faster than inflation and, in many years, faster than average earnings. On the other hand, with an aging population and increasing numbers of pensioners, the cost of the triple lock to the government and therefore taxpayers continues to rise. Some experts have suggested modifying the triple lock or replacing it with a double lock that removes the 2.5% floor. Others argue that any weakening of the triple lock would be a betrayal of older people who have contributed throughout their working lives. It's a complex political issue that isn't going away anytime soon. What should you do right now? First, if you haven't already, check your state pension forecast using the government's online service. This will show you exactly what you're entitled to and when you can claim it. If you spot any gaps in your national insurance record, investigate whether it makes financial sense to fill them with voluntary contributions. The deadline for making contributions for past years can vary, so it's worth acting sooner rather than later. Second, if you think you might be entitled to pension credit or other benefits, make a claim. Don't assume you won't qualify. The eligibility criteria might surprise you, and even a small amount of extra income can make a real difference, not to mention the additional benefits that come with pension credit. Third, review your overall financial situation. With the pension increase, your total income might change enough to affect your tax position or your eligibility for means-tested support. It's worth doing a full review to make sure you're optimizing everything. Fourth, if you're managing multiple pensions from different employers, now might be a good time to review them. Are they performing well? Are the fees reasonable? Would consolidating some of them make sense? These are questions worth asking, though always get proper financial advice before making significant changes. Finally, keep yourself informed. Pension rules and benefit rates change regularly, and staying on top of these changes means you won't miss out on money you're entitled to. That's exactly why we're here at Pension Path UK, to keep you updated with the latest information in a clear, understandable way. The 2026 pension changes represent a significant boost for millions of UK pensioners. With the new state pension increasing to £241.30 per week and the basic state pension rising to £184.90, that's real money that will help with the cost of living. But remember, these are maximum amounts, and your actual payment depends on your personal circumstances and contribution record. So there you have it, everything you need to know about the confirmed 2026 DWP pension changes. I hope this has given you a clear picture of what's happening and what it means for you. If you found this information helpful, please give this video a thumbs up. It really helps us reach more people who need this information. Share it with any friends or family members who might benefit from knowing about these changes. And of course, if you haven't already, subscribe to Pension Path UK and turn on notifications so you never miss an update. Do you have questions about the pension changes? Are you wondering how this affects your specific situation? Drop a comment below and I'll do my best to help or point you in the right direction. We're building a community here of people who want to make the most of their retirement, and your questions help everyone learn. Thanks so much for watching. Until next time, take care of yourselves, check those pension forecasts, and remember, knowledge is power when it comes to your money. I'll see you in the next video.